Good afternoon, everyone. I'm Ira Kotel, and I'm a partner in the New York office of Dentons, the largest global law firm in the world. And I myself specialize in corporate securities and capital markets transactions with a concentration that I've developed over the last couple of decades in medical device and life sciences companies. And I want to thank everyone for joining us today. This is the kickoff session of a new series of life sciences roundtables that we will be holding the rest of the year and into 2026, focusing on key issues and trends in life sciences and healthcare, topics of interest that are intended to provide practical, actionable insights that you can use in your respective businesses. Today's roundtable is entitled, and I need to take a deep breath, Capital at the Crossroads, Today's Life Sciences Realities with Think Equity and NASDAQ, State of the Markets. You can be looking forward to the next roundtable sometime in November, so stay tuned for that one. If you have any topics or ideas, drop us a line. We'd be happy to entertain that. We anticipate picking this series up, as I mentioned, in November, again in early 2026 after our annual networking event at the JP Morgan Healthcare Conference in January. And we certainly hope to see everybody in January at JP Morgan, as we've been doing for the last 20 years or so. The chat function is enabled. Other people won't be able to see it if you use it, but if you have questions along the way, feel free to type something out. We may be able to weave those questions into the discussion over the next hour along the way. Or maybe we'll figure out if time permits to handle a few questions at the end. Let me introduce the other panelists that we have here today. First, it's my pleasure to welcome my partner at Dentons in New York, Rob Condon. Rob is a securities lawyer with over 20 years of experience. He has specific expertise with life sciences issuers, as well as investment banks, underwriters, placement agents, and all sorts of financing transactions for life sciences companies, and is also quite accomplished in handling IPOs and direct listings and things of that nature. I'm also delighted to introduce Tara Sharif. Tara is the Managing Director of Investment Banking at Think Equity here in New York. She has broad life sciences experience in investment banking, corporate finance, and advisory matters. Thank you for being with us today, Tara. Really appreciate it.
Sure.
We also are privileged. Thank you. We're also privileged to have with us today Andy Hall. Andy's a Senior Managing Director at NASDAQ in New York. He's been there for over 2 decades. Andy's had a pretty broad portfolio there. He's probably seen everything that you could see at the exchange. And again, we're privileged to be able to hear from Andy today. Thank you, Andy.
Thank you.
Pleasure. Before we start the discussion, I'll draw a little bit of a roadmap as to where we're heading over the next hour. We're going to talk a little bit about the current state of the markets, investor sentiment across the life sciences sectors. We'll pivot then. We'll talk a little bit about IPOs and the various pathways to IPOs and going public. Andy's going to help us understand some of the key developments, regulatory and otherwise, at NASDAQ in terms of listing rules and regulations that will be of interest to companies that are public or thinking about going public. And then time permitting, we'll also get into some discussion of recent sort of financing alternatives in the market, related topics. Maybe we'll pick up some things in the regulatory environment, FDA, HHS, maybe the impact of tariffs, and kind of an outlook as we move forward into the end of 25 and into 2026. So why don't we get going with the state of the markets? As background, I'm sure everybody knows that it remains a somewhat challenging environment for life sciences companies as a whole. If you compare the sector to, say, 3 or 4 years ago, 2021, 2022, there was, I would say, better liquidity, more fundraising activity, certainly more IPOs, more SPAC IPOs, and then de-SPACs with life sciences companies. And, things are not as robust in 2024, 2025. We've seen some green shoots, but again, things have kind of leveled down from where they were 3 or 4 years ago. That's despite, and Tara, you could talk about this, that's despite, continuing innovation and growth in in the businesses of companies in these sectors. But how would you, Tara, characterize sort of the current state of the markets and maybe compare it to the earlier period and discuss investor sentiment a little bit?
Sure. As you stated, what happened during 20 and 21, the COVID really was a huge impact, even today. So we're kind of still living with the outcome of that. During the COVID time, because it was such an unprecedented event for life sciences, suddenly, we had this pandemic that caught on everybody and just affected so many people around the world. And there was a renegotiation agile. And I think that led into some level of exuberance, that and compacted by the fact that the interest rates were almost at a zero level. So there was like a huge amount of IPOs at least, and other, investments. We had went from being 14 or 15 typical number of IPOs per year to 9 in the 90s during the 20 and 21. So during the past few years, a couple of things had to have had to happen. Just a correction in a sense, and what we are experiencing since 23, 24, and this year is pretty much a calibration of what was happening during those exuberant years. So as the number of IPOs, for instance, is coming back to normal level, it seems like we went to like 16 number of IPOs in 22 and 13 in 23, and that seemed to was just the lowest pit, and then we are back to gradually coming back to normal level of investment or close to it. We are still, as you said, not quite there. The investments in early stage biotech companies are still very cautious and not have reached that level that before, but we see signs of life in the sector. XP was increased by 20% since April. The Liberation Day is been up. VC funding, it has definitely increased. A lot of mergers and acquisitions has happened that have kind of encouraged the whole sector. And in general, we see aside from specialists who are still interested in the sector and looking into it cautiously, but more so investing in companies that have data proven and or milestones coming by. We see generalists also kind of gradually coming into this and just maybe co-investing with them. But to answer your question, we see a gradual, back to normal. We are not quite there, but we definitely are getting very close to it.
Yeah, you're referencing sort of the generalists maybe starting to come back. They sort of rotated away, I guess. They went into other technologies, not life sciences, med device type things, chasing, AI and, various other sorts of investment vehicles. And then maybe there's, opportunity for this sector to once again flourish, because they've been a little bit, underappreciated, I suppose. What do you see as kind of the key drivers? You talked about the data, key drivers for growth and valuation in these markets. And of course, it does differ, right? There are certain subsectors that, may be treated differently, but why don't you address that a little bit for us?
So clearly, there are just some sectors that are always going to be, investment or heavily invested, as cardiovascular, cancer, and so on. But we also see some new areas coming into drivers like artificial intelligence and just high machine learning and high technology combining their efforts with biotech is a driving force. And then we see some new areas of investment, such as obesity that became very popular. Longevity is not a big name, and so on. But I could, to kind of indicate the sentiment of the market, maybe we can look at the this year, the number of IPOs, which is like about 24 or 25 this year, and kind of look at them just um, margin and just very generally to see what has been the sentiment of the investment community. And if I could just maybe summarize those 25 or so IPOs, of those, the 4 of them were in cardiovascular, which all have been up list and they have done really well. 4 were in cardiovascular, and they were like metabolic, as I said, obesity and inflammation and inflammatory mediators, as have always also been very, important in this area. And then we had some, interestingly, some Chinese companies coming in. We had like a few of the past, like as I said, the 25 or so, a few were from Taiwan and China. They're also gaining momentum, international companies.
Yeah. You mentioned the IPOs and obesity. One of the things we saw this year is Metsera went public at the beginning of the year with a nice valuation. Andy's nodding, obviously a NASDAQ company. And then they got taken out by Pfizer for almost $5 billion pretty recently. So that's a very nice sort of, nugget from this year. That's obviously a strong area of interest, for investors and for the markets. I think I read something recently that said there's about $300 billion of revenue that's coming off patent in the next couple of years for big pharma, and Pfizer took Metsera out. So, I think we are hopeful that you sort of need a number of different things to have a very robust biotech market. You need innovation, you need development, you need a cooperative FDA, which maybe we'll talk about later. You need a good regulatory environment, interest rates help. And then this sort of, you need venture financing, and you need M&A, including from the big pharmas, to kind of, be a foundational element to supporting all these things. And when you have 3 or 4 of those different sort of, supports, then we get, in the cycles I've been through, that's when you get, really good markets. So I guess we can be hopeful for that. And I think, as you said, there are some signs. So Rob, maybe we should pivot actually a little bit to talking about IPOs at this point and pathways.
Yeah, certainly. So this is a question for Andy. Right. I mean, we've seen the IPO markets beginning to pick up again. Do you expect healthcare to lead, lag, or stay in lockstep with other sectors? What are you seeing from the listings perspective?
Yeah, I'm going to go with the safe answer and say lockstep, Rob. So, as the other panelists have indicated, there was kind of a surge of especially pharma, biotech in 2020 and 2021. So there's a lot of capital there, and then those companies will go back out to market and look to raise additional money. So the new healthcare IPO, especially pharma and biotech, have to compete with that. But the environment is good. I'd say maybe it's great for some other sectors like technology and digital assets, but I would say it's good for the healthcare names. The ones that have gone public that I've looked at have performed well. Metsera, Cars Life, Heartflow. They're good charts in terms of their performance. And a lot of what the numbers that Tara shared, similar to mine. The 2021 was just an incredible year across the board for all sectors. 140 billion raised with NASDAQ and NYSE. The healthcare space was 164 IPOs. These are operating companies raising 24.4 billion. And then there was a fall off, and this is healthcare in 2022 and 2023, and 2024 looked a little bit better. There were a few, 24 in each year for 2022 and 2023, raising a little bit over 2 billion. In 2024, there were 26 healthcare IPOs raising 2.7 billion. And then so far this year, there's 27 raising 3.2 billion. A little bit of plug for NASDAQ. We do really well in the space of the healthcare IPOs for this year. That those 27, 91% have gone to NASDAQ and representing 84% of the proceeds raised. But yeah, I mean, it's as Ira indicated, it's a good environment. The VIX is low. The S&P, the volatility index of the S&P 500 is at 16. A lot for investors to be happy about. Indexes have hit all-time highs, and that's not just only the S&P 500, but the Russell 2000. So as interest rates go down, that's even helps the Russell 2000 and the healthcare stocks, because that reduces the cost of financing and raising capital. So you know, we're optimistic for the future. It includes healthcare.
Yeah, so you know the pandemic-driven activity of 21, right? A record-breaking year. I mean, hopefully we don't have a return to the reasons behind that robustness in the market. But you know, where do you see us going? You know, say for the rest of the year or in the last quarter and into 26.
Yeah, no, September was a great year. You know, we'll just have to see how. There probably won't be too much for October, depending on how long the shutdown persists. As we all know, it's a skeleton crew at the SEC. Only about 90% have been furloughed, so just a small crew there. So registration statements can't be reviewed or go effective. So we're hoping that lifts. But you know, leading up into the shutdown, a strong pipeline of good quality companies with good investor interest. For 2026, there's a data provider out there, Renaissance Capital, that kind of follows the IPO space very, very closely. They've even created kind of an index to track it. And the IPO index has performed, you know, maybe not as well as the S&P 500, but it's performed well. But they anticipate for 2026 to have 250 IPOs raising 50 billion. And to give you a sense of where we are right now, there's been 175 IPOs raising. NASDAQ's about 15 billion raised, as is the NYSE. We're about 133 of that. There are 30 listings, and the Amex is 12. But with that in aggregate, that's about 31 billion. So they're anticipating, and that's year to date right now in October, they're looking at 50 billion with 250 IPOs. And the healthcare mix in that historically has been between, say, 10 to 15%.
Okay. There was a lot of talk in 21 and 22 about SPACs, or a lot of activity in the SPAC market. What are you seeing in terms of IPOs in the SPAC market now, de-SPACs, and how does that compare to prior years?
Yeah, I mean, the SPAC market was off the charts in 2021 and in the subsequent years. There's been a lot of companies that have gone to market as a SPAC, and it's a good vehicle for that initial raise. You're going to get the investor participation because these investors, it's a way that they can put their investment into equity. So they're meeting that requirement of diversification into the equity space. They're parking it there. They're getting a good yield, and they're kind of paid to take a look. A lot of these investors don't ultimately go forward with the de-SPAC. But to give you a sense of how many SPACs have come to the market so far and have listed on NASDAQ, 90 SPACs raising 16 billion. So a lot of money there. The NYSE was 11, raising a little under 3 billion in the SPACs. But the art is, of course, finding the target, finding that private operating entity who is lured by the capital that could exist with that SPAC upon closing. Of course, we see redemption rates well into the 90%. So hoping to retain some of that investor base that stays with the operating company, and then they're able to de-SPAC and remain listed at closing, and they just don't expire. And we still see that market there. So far, we've had, for this year, 29 de-SPACs. So an operating company merged with that SPAC, successfully closed, and then became an operating NASDAQ listed company post-merger, and 29 of those year to date, and 70 in 2024, which seems like a pretty large number, but that's what we saw for 2024.
Yeah.
I would like to add something to what Andy said about SPACs. We find them not to be useful for earlier stage life sciences companies. They're more suitable for revenue generating, other sectors, say high tech, life sciences, and companies that are not, the revenue is not around the corner. Oftentimes after the SPACing have not done really well. And also the other issue is that the sponsors take, a lot of share of the future. So ownership. So in general, we don't recommend to early stage. Of course, that's different from later stage, but that's our advice to the younger companies.
Yeah, no, and that makes a lot of sense. Is there something that, and this is, to you, Tara, as well as to Andy, are there characteristics of life sciences companies that make them more attractive IPO candidates?
Clearly, data is everything. Management is by far the second most important thing. I have seen amazing companies with amazing data that the management somehow did not manage to bring it to the finish line. So that's key for investors, and they know it as well. And then data for earlier stage, we want definitely IND filed. We want them to have had their discussion with FDA. By far, extremely important to have the safety and then some efficacy. We would like to have a bit of phase 2 data. And then the nature of the data, the assets, are they all Me Too products that would add a tiny bit of margin to what is already available, or are they presenting a novel approach or a novel area of healthcare that is gaining more momentum? For instance, we see a lot of young companies coming to us that are presenting early diagnoses for the cancer particularly, because as you know, cancer by the time is caught on through imaging vehicles is oftentimes you're beyond several million cells, and God knows how many of them are already floating in the circulatory system. So more and more people are understanding that the amount of the months that you can catch a cancer earlier would definitely by far outweighs the treatment options down the path. So we see a lot of companies coming in with ways to find biomarkers in the blood, in urine, in saliva, and just early detection is going to be the way of the future for cancer treatment. Just think about how many, close to, I don't know, $500 billion you have spent so far on cancer, and we are adding, just immuno-oncology has been the most advanced recently, and we add maybe a year or so to the life, and the huge amount of investment in it. So as I said, that is an area that would just be important. For an instance, so to answer your question, what do they find just exciting, more elaborate, more sophisticated areas of technology, including especially with the AI that enables more advancements, and also where they are in the stages of development of the drug.
Do you see any
Yeah,
sort of...
if I could just jump in for a second. Yeah, in medical device, which I do a fair amount of, you have somewhat different considerations. Obviously, there's data and efficacy and things like that. I'm not a banker, but I've often heard them kind of give out rule of thumbs, and they vary, but it's kind of like $30 to $50 million in revenue run rates before you're generally of the right profile for the banks to want to take you public in that particular and there's obviously subsectors there too, and there's lots of AI diagnostic and developments in those areas as well. But the early stage, either pre-revenue or early run rates of revenue, that can be that could be a hurdle for the traditional IPO pathways. We did see a lot of those companies do de-SPACs, but whether or not they were really right and mature for public companies is subject to a lot of second guessing, I guess.
Yeah.
With Denton's being a global firm, we see a lot of international and cross-border listings. And this is a question for, I think for Tara as well as Andy. Given the political climate and tariffs, etc. What are you seeing in terms of international companies looking to list in the U.S., right? I mean, there's a lot of innovation that goes on outside of our borders, right? I mean, there's certainly a ton in the U.S., but Canada, Europe, Israel, we see a lot of innovation coming out of those areas. So has there been any impact?
I'd like to address that. We see a lot of opportunity companies from rest of the world, from Europe to Israel, Australia, a lot from Canada, that even have been on different lists, like Toronto Exchange. Ultimately, they seem to be still wanting to come here and list on NASDAQ or NYSE. We are the largest consumer of healthcare products and for obvious reasons. There's still that that willingness to come here, and interest has not abated at all, maybe marginally, but we do see a lot of that interest from other countries. I must say that it seems like recently there are more Chinese companies listing in Asia, and they're gaining some momentum, not just in terms of the advancement of the technologies coming from China, which is something that fairly new. We had not seen that in the past 5 or 6 years. There was dormancy was going on, and now we see a lot of high tech coming from China, Taiwan, Singapore, on cancer and other areas, and they also list elsewhere. But to answer your question, still the interest to come to the U.S. exchanges is very high.
Yeah, I would agree. The U.S. by far is the deepest pool of investor capital in the world. If you look at the total world market capitalization, the U.S. is over 50%. So NASDAQ total market cap of all our listed companies domestically is 35 trillion. The NYSE is 35 trillion, so over 70 trillion in market capitalization. The US is 27% of the world GDP, but over 50% of the market capitalization. So just a huge, deep pool of investor capital there. And with the political noise and tariffs, it surprisingly has not hurt that interest. Especially from Canada. Tara mentioned the Asian listings. Yeah, we're still getting kind of the smaller, there are some sizable Chinese IPOs, but typically smaller micro cap kind of IPOs out of China, but that's kind of spilled into Southeast Asia. So it's outside of China, it's Japan and Southeast Asia and India. They've looked to do small offerings and list in the US. And for Canada, you have this multi-jurisdictional filing status. If you're over 75 million in the market value of the public float US, and you're incorporated in Canada, and you have that listing on the Canadian exchange, and you look to add the US listing, those registrations are not reviewed by the SEC typically. So it's a 40F, a wrap around the annual report. You can keep IFRS in Canadian dollars, or it's an F10, a wrap around the Canadian shelf. So you file that registration statement. It's typically not reviewed, so then it goes effective in a matter of days. So you could file it on a Monday, do your roadshow during the week, price Thursday night, and be NASDAQ listed on Friday. So we're seeing it from the healthcare space, but particularly, just an incredible surge of precious metals cross listings from Canada. Given that gold at $4,000 an ounce, you could see that, but they're not holding back from the political climate. They want to access the US investor market.
Just one point about tariffs. It seems like they have dissipated. People accepted it. Nobody seems to care about them anymore. And it may have affected the device companies that depend on supply chain, that may have gotten a bit more expensive for them. And the cost of starting, manufacturing, establishing all that would take a lot of time and effort here domestically. But otherwise, it seems to be a thing of the past, hopefully.
Yeah, I agree with Tara. Policy can change, right, in a few years, or even in the short term, editing back what's required, and then as Tara indicated, people have gotten smarter with their supply chains when they have some exposure to tariffs.
Ira, did you want to switch to or start talking about some of the NASDAQ rule changes?
Sure.
Yeah, I think, yeah, Andy, why don't you tell us a little bit about some of the sort of recent developments at NASDAQ about its rules. There's been a number of changes with respect to the initial listing and continuing listing rules, and we'll hit on a few topics that might be of interest.
Yeah, I mean, there got some notice, especially in the kind of the microcap world in April. So basically, in sum, we weren't counting shares of the private company, investors that participated were investors in the private company towards the market value of the public float with the offering. So kind of our minimum standard for companies that are unprofitable is you need to have 15 million in the market value of the public float. So prior to April, you could count existing shareholders in the private company that would be part of the public float at the time of the IPO. So neighbors or early round fightings, they're investors in raising money weren't insiders or holders of 10% or more, that could be counted towards that $15 million number. So a company could raise 10 million in their offering and all that would be part of the public float. And then maybe they could count on at least 5 million of shares, privately held shares that would become public with the offering. So we kind of closed the door out on that. You couldn't count any of the private shares towards the market value of the public float at the time of IPO. So for companies that were unprofitable, they needed to raise at least 15 million. 5 million if you met this net income standard, but there were even in works of making that 15 million. It did not apply to public companies. So if you had a listing in Canada and you're looking to add a listing in the US, or you're an over-the-counter stock, we're not taking market value of public float away from you. That exists. So then that's part of meeting the 15 million is that current market value of public float, unless the company trades so little that it trades under 2,000 shares average daily volume for the last 30 trading days. And the logic there is that there's not enough liquidity in the market to substantiate that market value of the public float. So then you'd have to raise, like you're a private company going to the public market. That's broadly on the initial listing, which got some reaction. We got some pushback, but my response to that is that our standards have pretty much stayed stagnant for many years, and $15 million requirement 10 years or 15 years or 20 years ago is not the same 15 million today. But go ahead, Ira.
Yeah, and just Andy, I'll comment without taking a position on whether I like or don't like what you guys did on that. I'll just say that to some extent, in fairness, right? A lot of those shares that you don't count are locked up, right? The underwriters are trying to get as close to 100% lockup in those deals as they can. So they're typically not going to trade for, some 90 or 180 80 days anyway. So including them in the float was maybe not the most rational way of dealing with them, given the lockups. So,
and our reaction,
to be fair.
Yeah, and also our reaction that companies were raising so little. These were unprofitable companies going to market and raising 8 million. After you pay your fees and your advisors, there's not much left and to fund yourself. So in a year, this company potentially is a continued listing concern. So and that also helps in post-market trading. You want to raise enough with a good institutional retail mix so you're not vulnerable to the volatility of the market. So the retail investor, if it's all retail and you go below that offering price, they get skittish and you've got a hard trend to fight against. You want that institutional mix and to raise enough to be able to fund yourself so there isn't a worry from the investor base that the balance sheet isn't strong enough.
Yeah, and all of that led into a lot of companies with negative enterprise value after 21 was, but thankfully that number is decreasing. this year.
Yeah,
Sure.
better.
Yeah. Are you still seeing companies uplisting? OTC companies. What's the sort of state of play there, Andy?
I mean, it used to be a huge area where we would grab new listings. I mean, it sometimes, I remember years ago, we maybe have 30 uplistings a year. Not so much anymore. I think it's due to the rise of the SPAC market. So prior, the private company would look to merge into a OTC shell or a limited operating OTC.
And then move up.
And then move up, right? So now you've got this lure of this pot of gold potentially with this SPAC holding 100 million in their coffers, and you think, well, why go into a shell when I could go into this public vehicle that already has a listing on the exchange and has maybe a bunch of capital for us, upon merger. So that kind of pulled away that over-the-counter market. We still kind of see it with maybe other industries, community banks, or they file Form 10s and they register with the SEC, or they just decide, hey, we're big enough, we've got enough assets now as a community bank to go ahead and uplist. But yeah, not as frequent just because of the SPAC market. Here and there, we see it more with companies doing reverse mergers into already NASDAQ listed companies. So just seeing a synergy or seeing that company maybe struggling and using that public vehicle to go public.
Yeah. Anything you'd like to point out on companies that are thinking of doing a reverse merger with a NASDAQ, an already listed company?
Yeah, I mean, it'll probably be the change in control. So if that private company holds more than 50% of the stock, it's a change in control, and it's seen as an initial listing. So if the share price unfortunately was beaten down and the NASDAQ listed company is under $2, then maybe hopefully with the merger announcement it raises above $2. We do $2 for 90 consecutive trading days, $3 for 5 consecutive trading day, or a $4 for 1 day if you do it in conjunction with an offering. So you will have to adhere to the initial listing standards if you have the majority of control of that private company. And then also just be wary, you're inheriting that shareholder base. You're inheriting all the liabilities that are with that NASDAQ listed company. So just kind of gaining that NASDAQ listing, you're still going to be seen as an initial listing applicant anyway, is not the be all, right? You want to make the smart transition, whether it be an offering, maybe wait to raise enough capital and do a traditional private to public IPO, or even register with the SEC yourself and raise money privately and then uplist. So just be very cautious, because you're inheriting that entity, their shareholder base, their liabilities, their board, their management, and you're going to have to cipher through all that.
If I may just add one thing to what Andy said, for younger companies that are not perfect targets for SPAC, we do see and we do uplisting of OTC companies, especially from Canada. So we have seen some success in that way of the policy as well.
Yeah. And all this kind of ties into what you were talking about, Andy, in the context of the rule change that you were talking about, which is, from my perspective, it's important not just to see, can I get listed, right? But what's going to happen in the first 3 months, the first 6 months, the first 9, are you going to be in constant, danger of a delisting? You have to have some, realistic, credible projections about where you're going to be against all the continuing listing criteria, not just the initial listing criteria. And maybe an alternative or a delay makes or more financing, makes sense. It's no fun to live with that stuff hanging over your head all the time. It winds up dominating a lot of management time and being very distracting from their day jobs. So maybe, of interest to people, particularly in kind of the micro, smaller cap companies, is some of the developments around reverse stock splits. Can you talk about that a little bit?
Yeah, on a continued basis, we had to shore up our rules a little bit there, where we're getting pushback from the broker-dealer community, where companies were NASDAQ listed and they would just do series of reverse stock splits to maintain the listing. And the market making firms are just tired of making a market in these small, I mean, I'm talking maybe 10 million market cap or less stocks that still had this NASDAQ listing, and they've done a series of reverse stock splits. So now, and the way it works with the dollar rule for the audience, if you go down as a NASDAQ listed company below $1 for 30 consecutive trading days, you get a letter that you're deficient. You have 180 days to cure it. If you go back above $1 for 10 consecutive trading days, all is forgiven. You can then ask, after the first 180 days, you can ask for an extension for another 180 days. The new rule is that you can only do one reverse stock split a year, and over 2 years, you can't exceed a 1 for 250 ratio. So still very broad, very accommodating, but that was the change there. And then sometimes we see it for initial listing when companies do a reverse stock. Sometimes, as kind of Tara indicated, in Canada, where it's a Canadian company, there they like, and as in other areas of the world, in England and Australia, they're okay with low share prices. Here we like $20, $30, $40 stocks a share price. They're having $1.50 share price is fine as a Canadian company. And then almost all Canadian companies have this over-the-counter market that develops on its own. So they'll have the listing in Canada and the over-the-counter market in the US where investors can participate. And sometimes you see a fair amount of activity in the over-the-counter market on the OTC. But those Canadian companies would do a reverse stock split in order to meet that $2, $3, or $4 requirement. And a lot of people think, hey, worry about doing reverse stock splits. It's seen as negative. And yes, if you look at the broad data of reverse stock splits, you know, the percentages that the market cap goes down post split, but those are companies that are looking to kind of maintain their listing. There's something wrong with the business model. They need to correct that. It's a downward sloping chart. Whether they did the reverse stock split or not, they might have continual depreciation in their share price. That when companies are looking to gain a NASDAQ listing, things are going well. They, as I said, they inherited this kind of lower share price because maybe they issued out shares a lot as a mining company or a biotech in Canada, and now they're doing the reverse stock split because things are going well. They're looking to gain a NASDAQ listing, and they want a share price that has a better presence with U.S. investors. So when it's done in that manner, it's seen as a non-event or a positive event that they're doing it to gain the U.S. capital markets and gain the listing, and that's received well.
Yeah, I think it says something about the value that companies ascribe to a NASDAQ listing, that those downside companies, rather than just going to OTC, they'll do the split, which, you know, may accelerate kind of, you know, the share price issues in some ways, or the dilution, you know, to the stockholders, but they value the listing and the capital market access that it's considered to believe. I don't need to do promotion for you, but I think that's true. Can you talk to me a little bit about kind of the support that NASDAQ does for companies once they're listed?
Sure. Yeah. So because this is a competitive marketplace with the NYSE and NYSE American and NASDAQ, unlike in other countries where there's just really kind of a monopoly with one exchange, you pay your listing fee and that's it. We do a little bit more. There's a service element there. It's just not pay your listing fee and, you know, and hopefully not get a letter from our compliance area if we fall foul with one of our listing rules. We try to help the companies as well, because their performance and them doing well and received well in the investor community, you know, helps NASDAQ. There's an intangible value there. So it's not just pay your fee and that's it. You know, of course, around the listing, we have some visibility assets, and then also some IR services out there as well that come with the listing to help with that investor communication. So there is a service element from an IR service and a visibility perspective to help companies as newly listed ones, of course, but on a continued basis.
Terrific. Thank you. I think we'll pivot now. Rob's going to, you know, kick off a little discussion about kind of financing structures, options in the marketplace these days.
Direct some of these questions to Tara. Right. I mean, you know, we're talking about life sciences companies, pre-revenue, preclinical, clinical stage, capital intensive, right? I mean, they need money to do their clinical studies, and to advance their candidates. Once they're already public, right? What advice, is Think Equity giving to listed issuers in terms of timing financings to, say a data readout, or an FDA event, or some other newsworthy item, the contract with the supplier.
Yeah. So we want them to continuously educate the investors. They just every time just send out 8Ks and PRs to make sure people are educated about their advancement. And clearly for the life sciences companies, post IPO, the critical what is critical is to reach the milestones and announce it, to let everybody know that they're making progress. And typically, after a milestone is reached, a readout or continuation of a phase or so, that is a better time to go back to the market and raise capital for obvious reasons. But we advise them to continuously be in touch with the investors and let them know about their progress.
Yeah. How do you advise them in terms of having options available for accessing the capital markets, right? Putting up a shelf, having having
right.
a registration statement available.
Yeah, we are very conscious of the shelf filing, because that's obviously a very good thing to do, saves time. And just as obviously they have, after the IPO, they need to be a trading company for 12 months before they can exercise their shelves. But we file them, and maybe confidentially, S1 confidentially, or a shelf, enable them to go to the market when the market is favorable, when the condition is favorable, when the good readout comes out. They can just, with a shelf takedown, that would be a very good way to do it. And if that's not possible, we do a confidential S1.
Right. Is there a preferred structure from your perspective, for the issuers, in terms of, say, a registered direct versus a PIPE versus a confidentially marketed public offering?
Yeah, I mean, pipes, we don't really get involved too much with the privates, because they're not as, people think that they're fast, but they take just as long. And oftentimes the private investors ask for kind of difficult terms. So we prefer to just do a shelf takedown. That might be better. Registered direct, also, if they have a shelf available and the investors have been educated, that's good. Otherwise, they would have to do, just more of a marketed raise. So yeah, those are their usual options.
Yeah. I think one of the considerations, right, between a registered direct and a we'll call it a CMPO, is the public marketing perspective and advantage for that, right? NASDAQ has a 20% rule, where if shares are being issued at a discount to market, would you advise folks to go the CMPO route versus an RD because of that? It just really depends on appetite and the company's news at the time.
Yeah, I think it's just case dependent. So we don't have a general rule for that. We just for every case, we just take all the options into consideration and advise them accordingly to what's best at that time.
Yeah. Do you see terms being materially different for one structure versus another, right? In terms of discount, or clearly, like a PIPE, is probably gonna have a greater discount because
Right.
the shares aren't liquid until a registration, resale registration statement's filed, or the 6 months have passed. No one wants to go that long, tradable shares. But
Yeah. We see the best terms come with shelf takedowns, and that's our experience.
yeah. Do you see any other types of financing structures, right? I mean, typically an issuer is going to want, you know, like a straight common deal, but you know, are you seeing convertible debt? You know, when do you see warrants as part of the package?
Yeah. So sometimes, speaking of uplisting of OTCs, we have to kind of add warrant, you know, make it a unit. We try not to. We prefer to do common. And in fact, that Think Equity, most of what we do is straight common because we don't want to, you know, just hang over of the warrants. But at times we have had to throw that in as a unit. We don't really advise any like debt or convert, because especially for companies that don't have revenue, that could be very detrimental down the path if they have any debt that is not converted at the time of IPO.
Yeah. Do you see any other sort of structured offerings going out to market and follow-ons, or you know, it really just depends case by case?
We don't do too many structured deals. We try to stick with common only for, especially particularly as we all discussed today, younger companies, you put them in a danger zone. So with common is just easiest.
We're sort of getting down to our last few minutes here. Ira, maybe we'll talk a little bit sort of about the more general, you know, macroeconomic features that
I think we,
affect
you know,
companies.
Yeah, thanks, Rob. You know, I think we hit upon a number of those things, but I wanted to kind of, you know, ask Tara, you know, so we're in the government shutdown. You know, it was mentioned, you know, the SEC is generally closed for business right now. FDA, because it's industry funded to some extent, has more than a skeleton staff, I would say, but there's certainly, you know, and there's been reductions in force there, you know, during the year. What are you hearing? What are you thinking about FDA, HHS, developments, shutdown, impacts? You know, anything you'd like to share in that regard?
Yeah, the shutdown of the government, we know it's going to be temporary. So we advise our clients to just file, and, you know, even if they don't get the response back in 2 weeks, it will still get them back. It's not going to be a huge detriment. But this situation with, you know, the FDA coming down on like vaccines, and then encouraging, on the other hand, certain other drugs that they consider more important, and then coming down on this whole human cell and tissue, you know, that they came up with Section 361 versus 351, that, if you recall, and still is going on, just about everybody who has some kind of clinical practice is injecting stem cells into people, various parts. And so, you know, FDA came down on that, and so they put these products into two buckets to find the ones that are low risk and the ones that would require a complete, you know, just trial base. And so that certain things that FDA has come down, we feel that are useful, but then some of these new ideas about vaccines being, you know, not good, and then that could have some lasting effect on development of the drug. So companies are watching those rulings that are coming out from FDA and government in general very carefully, and embracing them as they come in. I saw yesterday something about, you know, this development partnership that the government has with Pfizer to lower the prices. They call them Trump or RX, that could benefit some of the, you know, Medicaid and Medicare patients. So that affects the pricing. So there's just different things, pricing influence, and then just which products are to be developed, and this selecting of, you know, kind of preferentially could have lasting effect. But like everything else, we just have to wait and take them in a stride and make adjustments.
Yeah, we don't
as
know.
needed.
We don't know a lot of the details yet. Although for some reason the market perceived, maybe because they thought something could be worse, the big pharma impact, at least in, you know, short-term stock price, was positive to that
Yeah.
development. So
Yeah.
yeah,
I mean,
well,
we
there's a lot.
spend Right. So we spend about close to 5 trillion a year on healthcare. So we have room for absorption of shocks.
Yes, yeah,
And one comment
that's true.
on the SEC shutdown, yeah, it's freezing kind of the IPO market, but for well-known seasoned issuers, they can still register and do their offering. And even for non-well-known seasoned issuers, if you've got an effective S3 shelf, then you can draw upon that.
Yeah, that's right. We're monitoring, those developments, and the automatic shelf people are moving forward. Other people are filing and hoping that it's not going to be for too long. You do see a drop off in new deals for kind of smaller companies. I mean, it's only been a week, so it remains to be seen, but we are monitoring that pretty carefully. But for the biggest part of the capital markets by market cap value, they're generally in a pretty good shape to move forward without the SEC. So interesting times. Well, I think we're at just about time. I want to thank everyone today, especially our guests, Tara and Andy, for their participation. It was a great conversation. Thanks so much for joining us today. And I look forward to working with you guys on a variety of things going forward. For our guests, I just want to mention again that this is the first in a series of roundtables that we'll be having. So stay tuned. We'll be announcing the next topic and getting out invites and promoting that over the next month or so. We'll pick it up again with something different in early 2026 after the JP Morgan conference. And I hope you found it of value, and we welcome your feedback and suggestions going forward. So thanks, everyone, and have a great day.
Thank you.
Bye.